Our objective is to deliver superior returns from active multi-manager investment in global equity markets, and we aim to deliver dividend growth, which comes from choosing companies which can grow their cash flow over time, and to deliver capital growth, which you can only really do if you buy investments at the right price. Multi-manager, obviously enough, is using more than one manager to look after your assets, and the reason behind it is partly to diversify some of the risk from choosing a single manager where performance can vary from time to time, so you're smoothing that out a bit, but also you can choose people who are specialists and play to their particular strengths, that somebody who's good at Asian equities may not be an expert in North America, for example. We go through a rigorous selection process looking across the full range of available investment managers to try and choose people that we are willing to partner with over multiple economic cycles. We don't want to chop and change unless we have to. So we try and choose people who are resourced and have a thought process that gives us confidence that they're going to add value in the medium term. And we monitor them through a range of measures, both in terms of performance and in terms of personnel changes. And that monitoring process includes a formal presentation to the board every year, which is not so much pitching for their job again, but it either gives reassurance that the reason that we appointed people still stands, or it can sometimes indicate that weaknesses are beginning to appear. And from that point of view, the process is useful. Well, as Chief Executive, I lead the team which is responsible with the board for delivering investment performance to shareholders, but also to ensure that the company is soundly run, that we do proper due diligence on all our suppliers, and in specific investment terms, the areas of responsibility that we cover are we vary our gearing according to opportunity throughout the year. We make sure that we operate a shareholder-friendly buyback programme, and the team at Witan also invests up to 10% of the assets in a series of specialist funds where we think that there are asset classes that are attractively valued, but where our managers may not naturally buy them. Well, the outlook in the next 12 months, I think, is a little bit for more of the same economically. There are no windfalls in equity markets at the moment because valuations have re-rated on the back of low interest rates and so forth. But economically, over the last 7 or 8 years, we've had a gradual healing process after the financial crisis. And as a result of that, economic growth has been slower than expected, but it has been positive most of the time. And I think that's, broadly speaking, going to continue. So I think a selective approach to looking at markets is going to be required. Politics, well, as we've seen in the last 12 months, truth can sometimes be stranger than fiction. And so I'm not going to make any predictions on politics, but usually markets are more driven by the economics than the politics. And I think in the longer term, I mean, there are times when you can look at equity markets and there's a real opportunity. It's like seeing a £20 note on the pavement. It doesn't happen very often, and this isn't one of those times. But usually making money out of equities involves patience and hard work. And we see it as our job at Witan to do the hard work on behalf of our investors so that their patience and their trust in giving us some of their investments to manage can be rewarded.